This is episode 258 of Zen and the Art of Real Estate Investing with my guest, Andrew Cushman. Andrew is the founder and principal of Vantage Point Acquisitions. He left his career as a chemical engineer to get into real estate in 2007, started with house flipping, went over to multifamily in 2011, and since then has syndicated or repositioned close to or over 3,000 multifamily units. Andrew, welcome to the show.
Good to be here, Jonathan. Appreciate it.
Yeah, and we were just talking. You're in a power outage. We're recording in a power outage, so things could get a little wonky, but thanks for sticking it out. And it's good to have you.
Yeah, for anyone who watches the video, it kind of looks like I'm in the witness protection program here, but I got no lights, but I got a laptop on battery and a phone hotspot, so hopefully it makes it through. So
Yeah, modern technology. Let's do it. So why did you leave chemical engineering for real estate in 2007? Was it something you thought of before, or was it something that just happened?
it was something I thought of in high school, actually. As a kid, going all the way back to 5 years old, I was, when I was five, I'd walk around the golf course with my grandfather that he lived nearby.
Mm,
And I'd fish the balls out of the rough and the bushes and then clean them up and then take my little red wagon and go sit at the crosswalk and sell the balls back to the guys who had lost them.
yeah,
And so I got a picture of me at 5 years old holding $17 and I felt like I had all the money in the world, right?
that's rich.
And,
Yeah,
and of course, this is the early 80s, so it actually was a meaningful amount of money. But
yeah,
and so I was just doing things like that ever since that age. And in high school, I knew hey, I want to be an entrepreneur. I want to do my own thing, but I had no idea how to do that or what that meant. So I figured, hey, I'll just go get a chemical engineering degree in the meantime. That way I'll always have job opportunities and they'll always pay well until I figure out what I really want to do. Got the engineering job, got married. 7.5 years into the engineering job, my wife and I tried a bunch of businesses along the way, and then we discovered the flipping,
yeah.
and it was brutal. But we finally got our first deal after 6 months, and then when we sold that, we made as much as I made all year long at my
Yeah.
engineering job, and I said, "All right, that's it. There's no better sign than that. I'm out." This was 2007, as the economy's collapsing, but I'm like, I don't care. That means there's gonna be an opportunity to get houses, and
Yeah.
uh, you know been full time in real estate ever since, and I, like you said, after a few years, transitioned to multifamily. So
For people's first time raising money, how was it when you had to go out and get money? Who were you going to? Was it people who already trusted you in other professions? Or how were you trying to market it? Because now it's a different story. Everybody has flashy PDF, everything looks great. But back then it was a little different. And you were still new to the space, really, not new to real estate, but new to multifamily, which makes it a little harder.
it was very hard. And candidly, we're kind of getting back to how it was in 2010, 11. I mean, we had, if you think about that time period, we had just hit the bottom of the most significant real estate crash in, generations.
Yeah.
And because of that, everyone was terrified of investing in real estate. In reality, that was the best time in probably the last
Yeah.
70, 80 years to invest in real estate, which is typically the case. Everyone does the opposite of what they should do. So it was really hard. So our first check was my mom. And then basically what we did is we went out to everyone. So how we funded the flipping business is private money. We'd say, hey,
Mm,
we're buying
okay.
this condo for 300,000. We need to give the guy 100,000 cash. We'd just go to somebody that we met over time doing the business and say, okay, we need 100,000. We'll give you 10% interest in 2 points. And so we had built up a small list of investors that way. Then when we went to multifamily, we of course went to them. Some of them did come over to multifamily. And then we expanded from there and just kept, networking and networking and networking. Like I said, we had to raise $1.2 million. Took 6 months. We almost didn't get there. How we finally got across the finish line is we actually went to the seller and said, hey, and this is very true. We said, look, your property's in a lot rougher condition than we originally thought.
Yeah.
We're not going to retrade you on price, but we want you to carry a note for a few $100,000. And he agreed to do that. And that's how we actually get the last big chunk of the equity. And then we repositioned the property, refinanced a couple of years later, paid everything off, and we were good to go. But that's how we did it. These days, it's kind of similar. in that, I mean, even from just 6 months ago, it is, people are far more hesitant to invest than they were, even six
Yeah.
months ago. Now, part of it has to tariffs, tax on, tax off, and all this other stuff that's going on in the world, and people are just uncertain, and the sphincters tighten up when that happens.
Yeah.
But also, it's just kind of real estate's gotten kicked a little bit, and so people are scared. It's like, actually, no, now's the time to do it. Not when it's going up and everyone's jumping on the bandwagon, but you want to already own it at that point. So you just sit back
Get
and
the
then start.
rise.
Yeah, and then start, and when the rise, after the rise goes for a little while, now then you start selling into the frenzy and do that kind of thing. So
During the time when syndications, everyone, was investing in them, 2020 maybe to 2022, did you find a lot of operators were thinking everything was going to be more 3 to 5 years, but then ooh, now we hit a cycle where that's not really possible? Do you think that's part of the reason why some operators and some of these syndications got messed up during the time? I mean, that's what people are reading about, and maybe what scares people from syndications.
I mean, that's one of several reasons. Is people developed way too short term thinking for
Yeah, yeah,
commercial real estate. Um, And then, on top of that, there was a good period of 5, 6, 7 years where operating these things was easy. Like, you just had to, again, follow a YouTuber and take massive action, go buy it, and rents went up and it stayed full and everyone looked like geniuses. The
yeah,
problem is I mean, every single multifamily guru camp and all that I've ever seen, like, including the legitimate ones, all they focus on is how to get the deal, and then how to raise the money for it. I don't know of a single one that tells you what to do on day two after you close, right? Like, what do you actually do with this 100-unit property that you just bought that is got 100 families living in it? And now you're a big part of their lives, and you have 100 investors in it who are counting on you to not lose their money. No one teaches what to do then. And part of what's happened is again, for a long period of time, you did not have to be a good operator. Things just went up.
yeah,
Now you actually have to be a really good operator in order to have your property, just to do decent. And what's happening is all the folks who quit their IT job 3 years ago, 4 years ago, because they went to a camp and the market was booming and, hey, this is easy. It's not. Uh,
yeah.
and that's another reason. So you have people overpaid who use the wrong type of debt and don't
Oh,
have
yeah.
the operating experience. And now you don't have to have it, but you should have someone on your team who does, right? And so you put those three things together, and yeah, you end up with a lot of deals going bad.
I think
Hmm.
people just have to come around to really, like, what is passive income, and what are they really looking for? And most people, again, as I was saying, and probably you've experienced, it's a control thing within yourself. So the self-awareness of the investor is really important, because you have to know, like, I'm ready for this. I'm ready to want something that really is passive, meaning I can't turn any knobs. It's
Yeah.
just out of my hands altogether.
I mean, the only true passive income is, you maybe, buy Johnson stock and they give you a dividend every quarter, or treasury bills where you
Right.
just get an interest payment every month. I'm in a mastermind called Go Abundance, and we call it horizontal income, meaning
Yeah.
it shows up on a regular basis. It's consistent. It's reliable. You don't have to necessarily grind every day to get it, but there's still some form of management that needs to be done, or attention paid to it, or or some kind of involvement. And so, especially as a sponsor, it's not passive at all. It's a full time job. I mean, we've got a whole team of people that we employ, and that doesn't even count people on site. I think every year I think we have to send out 600 K1s or something. I mean, just tax season is a giant ordeal in of itself. So
Yeah.
there is nothing passive about it, unless again you're an LP. But even as an LP, it's it's passive once you make the investment,
Yeah.
but it needs to be active up front when you're vetting the sponsor and vetting the deal. You need to spend some time digging into that And then also
Yeah.
actually read the quarterly or monthly reports and, and follow up with, whatever's going on. So